Navin Fluorine's quarterly results were broadly in line with our expectations this time. In our ideas for profit today, I'll discuss if investors should really consider getting into the stock at the current levels and post the Q1 earnings. Well, the specialty chemicals segment posted a revenue growth of 13% year-on-year. In Q1, that was benefited from the debottling initiatives as well as the higher market share in the overseas market, which was partially offsetting the 12 crore rupees sales loss attributed to the COVID-related disruptions. Now, in case of the CRAMS business, the growth visibility has improved in the last couple of quarters, particularly with the start of the new facility in Devas. Now, sequentially, there was a dip in revenue, but the company is hopeful of ramping up operations in the following quarters. Now, legacy businesses, refrigerants and inorganic fluorine were severely impacted due to subdued demand. Also, steel industry in particular is operating at a very low capacity right now, and that is due to the weak demand and the destocking as well. Now, impact on the refrigerants business was due to the weak volume offtake of refrigerant gases for auto and air conditioner sales in an otherwise quite a strong season. Now, its EBITDA margin gain was mainly aided by the gross margin improvement, partially offset by the higher employee cost for the CRAMS expansion as well. Now, both lower raw material costs as well as the better product mix definitely helped the company this time. Both the refrigerants and the inorganic fluoride businesses are expected to remain lackluster in the near term as well. However, this shall partially be offset by the demand for the non-emissive applications such as feedstock in pharma industry. Now, we do expect a slightly negative revenue growth in this segment in FY21 as a whole. Now, near-term prospects for inorganic fluoride businesses are also quite uncertain due to the subdued demand in the steel as well as the glass industries. In the near term, growth would be aided by higher margin segments such as the CRAMS business and specialty business, which now constitute about 64% of the sales. Now, the 7-year deal with a global company to manufacture and supply a high-performance product or HPP in the fluorochemical space is a welcome development at this stage. We do think that it is fundamentally positive for a company which is largely caters to cyclical businesses to actually get into exposure into a relatively stable earnings stream. Now, supplies to the client are expected to be dispatched from, say, Q4 of FY22. Now, fluorospar dependence on China is under 20% of its requirement, and the firm has developed alternative sources for this material as well. The sourcing risk is quite limited to that extent. However, the price risk cannot be avoided at this stage, and it remains a key risk to watch going on from here. We do expect Navin to sustain EBITDA margin in the range of say 22 to 25%, and as far as the stock valuations are concerned, it is currently trading at 25.8 times EV to EBITDA FY22 estimated earnings, which clearly is well ahead of the multiples enjoyed by its peers such as SRF, Aarti Industries, Atul Limited. Now, overall, on the one side, cyclical nature of some customer segments, glass, steel, auto, even white goods, they were exposed in the quarter gone by, but the strength in specialty business was definitely encouraging. Further, the strong commentary for CRAMS and specialty and also the evaluation of new business verticals in fluorochemicals made us review this investment case this time. So, Navin Fluorine is among the select few firms in emerging markets dealing with complex fluorination abilities and is seeing strong interest from multinational innovator companies in the life science and crop science space who wish to partner it. Now, on the back of the encouraging management commentary also, in these kind of difficult times, we think that only long-term investors may accumulate this stock on declines.